The Federal Reserve has decided to keep interest rates unchanged in the range of 3.5 to 3.75%. This outcome aligned perfectly with what nearly everyone on Wall Street anticipated, making it one of the least surprising calls in recent memory. Yet here is the real puzzle: why might this seemingly boring pause carry far more weight than an actual easing move ever could? The simple truth is that maintaining the status quo stops being benign once the central bank finds itself cornered with no good options left. Look back at the previous occasions when the Fed ended up in this exact bind, squeezed hard between stubborn price pressures and a cooling economy unable to lean either way without causing pain. In those moments, gold delivered explosive gains, first surging around 73%, then exploding by 325%. And later climbing about 12% even under tough conditions. Very few people manage to get positioned ahead of those powerful rallies. Right now there exists only a single plausible path for gold to head lower from current levels. Just that one lonely possibility? Once I walk you through it, you will quickly grasp why mathematics and reality have slammed that door shut for good. Tonight the big issue is not if gold will rally further. The deeper question is whether you truly see why this particular pause stands apart from all the previous ones in the books. I am Claire, and for more than 10 years I have immersed myself in poring over Fed meeting minutes, following the movements of official gold reserves and dissecting the recurring mistakes made by central banks worldwide so that you can skip the heavy lifting. If you are eager to cut through the polished media spin and grasp the genuine message the Fed is sending this evening, then please tap subscribe and drop a like to help spread the word. Before we jump deeper, I would love to hear from you. What price do you forecast for gold by the close of 2026? Share your prediction in the comments section, because 90 days from now I plan to revisit this exact discussion and we will compare notes to crown who came closest to nailing it. Let us lay out the core idea clearly. The Fed is not calmly choosing to stand pat. It is effectively paralyzed. And being paralyzed differs completely from exercising deliberate patience. Patience implies a thoughtful strategy and the discipline to await the ideal window for action. Paralysis, on the other hand, means that every possible step forward risks inflicting serious harm. Lowering rates now would likely fan the flames of inflation once again. Pushing rates higher would threaten to tip an already sluggish economy, with growth barely scraping 1.4% into outright contraction. The institution is genuinely stuck. Every historical example I am about to unpack demonstrates the same outcome. Whenever the Fed gets locked in this inflation versus recession vice, gold refuses to merely creep upward. Instead, it fundamentally revalues the whole system of money itself. What sets 2026 apart, however, is a powerful new force absent from those earlier chapters. Central banks worldwide have fundamentally altered the underlying dynamics of the gold market, and this shift dramatically influences both the velocity and the potential scale of the current advance. Allow me to transport you back to 1973 for context. Arthur Burns sat in the Fed chair position. The OPEC oil embargo had suddenly delivered a massive energy shock that hit the world economy like an unexpected locomotive. Crude prices quadrupled in practically no time at all. Inflation began its sharp ascent. Here is the crucial detail: though the broader economy was simultaneously losing momentum, Burns confronted the very first incarnation of the dilemma the Fed faces today. He faced a stark decision: either tighten policy forcefully to combat rising prices at the risk of further damaging a fragile recovery, or maintain steady rates and pray that the oil disruption would eventually fade. He opted to hold steady. He decided to wait it out. He selected what appeared to be the least risky route in the short term. Meanwhile, gold, freshly liberated from its official fixed exchange rate after President Nixon ended the gold window in 1971, reacted in a way that shocked Wall Street. It climbed roughly 73% over the following 12 months, precisely because the Fed hesitated to respond with conviction. The surge stemmed not from wild speculation or hype from tip sheets. Markets simply observed a central bank that appeared incapable of decisive action and reached a unanimous conclusion. If the guardian of the currency refuses to defend it, then another protector must step forward. That protector turned out to be gold. The Burns chapter established a timeless rule that has endured for more than half a century. When the Fed becomes immobilized, it is never mere passivity. It broadcasts a clear warning. The warning signals that the central bank has surrendered control over the prevailing story. And once that story fractures, capital refuses to sit idle waiting for a replacement narrative. It rushes toward the one asset that requires no story at all to justify its value. That asset remains gold. That episode delivered a 73% advance, yet 1973 lacked a critical element that exists powerfully in 2026, an element that completely transforms the support level beneath the entire gold proposition. I will explain it soon, but first it is essential to recognize just how dramatically this recurring theme can intensify. What followed next dwarfs the 73% move and makes it seem almost trivial. Fast forward to 1979. The Iranian Revolution sparked another severe oil disruption. Inflation roared higher once more. This time the Fed was led by G. William Miller, a figure who appeared even less resolute than Burns by contrast. Miller examined a softening economy paired with accelerating price increases and arrived at essentially the same judgment Burns had made. He concluded the economy was far too vulnerable for bold rate increases. He believed inflation would eventually cool without forceful intervention. His miscalculation went beyond simple timing errors. He fundamentally misunderstood the mechanics at play, and the length of his hesitation proved astonishing. Here is the key evolution in thinking. Burns demonstrated that the Fed is capable of freezing in place. Miller revealed that such a freeze can drag on much longer than conventional wisdom anticipates, and crucially, the longer the freeze persists, the larger the resulting gold rally becomes. From roughly $200 per ounce, gold rocketed to $850 per ounce within just 18 months. That represents a staggering 325% increase, not stretched over 10 or 20 years but crammed into a year and a half. Pause and let that figure sink in. The rally did not fizzle because buyers vanished or because the position became overly popular. It halted only after Paul Volcker took charge near the end of 1979 and took the step no previous chair dared. He drove rates all the way to 20%. Volcker did far more than tighten policy. He deliberately embraced a deep recession as the necessary cost to rebuild the Fed's shattered credibility. He cured the inflationary illness by almost destroying the economic patient in the process. The most relevant insight from the Miller period for our current situation is this. Burns paused for several months, leading to a 73% gold gain. Miller paused much longer, fought harder, and clung desperately to hopes of a gentle slowdown, yet gold exploded 325%. The lesson extends beyond paralysis, simply lifting gold. Extended paralysis generates compounding exponential revaluation. Every extra month without action multiplies the upward pressure. And come May, a new figure will step into the most influential seat in global finance, potentially prolonging the current impasse well beyond current expectations. I will name that person in a moment. First though, let us examine the third chapter, because this is where denying the pattern becomes impossible. Turn to 2021. Under Jerome Powell, the Fed observed oil-fueled inflation rising steadily month after month, yet labeled it transitory. They maintained near-zero rates. They continued aggressive bond purchases. They repeatedly assured markets and citizens alike that the pressure would dissipate naturally. By late 2021, Powell publicly conceded the mistake. The transitory label was quietly abandoned. In the 90 days that followed, gold managed to rise around 12%. I can almost hear your reaction. 12% seems modest next to 73 or 325. That reaction makes sense on the surface, yet it misses the bigger picture. What makes that modest gain extraordinary is the backdrop. Markets had already fully priced in the fiercest tightening cycle since Volcker days. The whole financial world prepared for rapid rate increases. Every conventional headwind that typically depresses gold was blowing full force. Despite all that, gold still pushed higher. That is the crucial update from the Powell era. Even after the Fed acknowledges its error, even after it shifts aggressively to repair the course, gold continues to benefit. The damage to credibility occurs before the confession. The confession does not heal it, merely confirms the wound. Recognizing the trap does nothing to disable its mechanism. Combining all three cases yields the single most vital takeaway. Burns showed paralysis is possible. Miller showed paralysis can endure far longer and propel gold much farther than logic suggests. Powell showed that even a sophisticated modern Fed armed with vast data and tools can fall into precisely the same mistake across three different leaders spanning three different eras. And that pattern lands us squarely in March 2026. Data straight from the St. Louis Fed reveals fourth quarter growth limping at 1.4%, PCE inflation holding around 2.8%, and unemployment sitting at 4.3%. These numbers scream stagflation. The Fed's twin objectives have collided head-on: easing policy risks, reviving inflation; tightening risks, shoving a vulnerable economy off the cliff. The freeze remains firmly in place and the historical script is running again. Everything described so far, the 73%, the 325%, the 12%, unfolded when private traders, speculators, and momentum-chasing funds dominated gold trading. Directional bets flowed based on emotion, headlines, and fear. Now consider the game-changing question that should reshape your entire view of this cycle. What changes when the dominant buyer shifts from nervous retail players who bolt at the first dip to sovereign entities that never sell in panic? That shift defines 2026 and separates it completely from 1973, 1979, and 2021. Recent figures from the World Gold Council indicate total quarterly demand from central banks plus investors hovering near 585 tons. Central banks alone account for about 190 tons each quarter. Major actors include China, India, Poland, Turkey, and Singapore, among others. These are not momentum-driven hedge funds. These represent countries deliberately diversifying reserves away from dollar assets over many years. They accumulate during weakness. They accumulate during strength. They accumulate irrespective of price because their goal is not short-term profit. Their goal is preserving national independence. This behavior forges a brand new feature in gold markets, a solid institutional bid floor that never existed before. Back in 1973, overheated rallies invited heavy speculative liquidation that could tank prices. In 1979, Volcker's extreme tightening drained speculative money and gold corrected more than 50% from its high. In 2021, the brutal hiking cycle kept gold suppressed for almost 2 full years. Today, however, any meaningful dip triggers central bank buying, not for bargain hunting, but because strategic necessity overrides price considerations. The support level has become official and enduring. The upside remains driven by speculative forces. Pair a paralyzed Fed with this unprecedented demand floor and the outcome flips from debatable to inevitable. Direction is locked. Only the pace remains uncertain. Let us now explore that pace, because this is where things turn truly fascinating. Two of the sharpest predictive tools in finance currently offer conflicting timelines, yet both scenarios favor gold strongly. According to Goldman Sachs' March 2026 analysis highlighted across financial media, they have shifted their expected first rate reduction to September, believing one cut arrives before year-end. Bond futures priced through the CME FedWatch tool tell a different story, pricing just one cut by December 2026, with further easing delayed deep into 2027. That disagreement between September and December creates the volatility window for gold over the coming 3 months. Here is the overlooked reality: both forecasts are constructive for gold. Should Goldman prove correct and easing begin in September, real yields drop sharply. Lower real yields make gold far more compelling compared to any income-producing alternative. Gold advances directly on the cut. Should futures prove accurate and the Fed remains stuck through December, nominal yields appear stable. Yet inflation expectations continue rising, fueled by energy costs, trade policy risks, and persistent structural drivers indifferent to short-term Fed moves. Stable nominal rates combined with climbing inflation expectations produce declining real yields indirectly. Gold advances through the same real yield channel without needing an actual cut. One route delivers quicker gains, the other slower progress, but both converge on higher prices. Recall the lone bearish scenario outlined early, the single theoretical escape where gold falls. It requires the Fed to actively raise rates, not merely hold or ease gradually, but tighten policy into an already softening economy. As of this evening, that possibility carries zero implied probability across futures pricing bank outlooks or the latest dot plot. 0. The escape route may exist conceptually, but it is barricaded solid by 1.4% growth and 4.3% unemployment. Tightening under these conditions is simply not feasible. Every realistic path, therefore, points toward higher gold. The remaining choice is which timeline unfolds. One additional wildcard looms in May, capable of speeding up the entire narrative. Most viewers tune out here assuming they already understand the implications. Resist that temptation. Jerome Powell's chairmanship concludes on May 23, 2026. The anticipated replacement, Kevin Warsh, carries a reputation for greater hawkishness compared with Powell. I hear the immediate pushback already. A more hawkish leader should pressure gold downward, right? Would that not signal impending hikes? Here is the nuance rarely discussed in Fed transitions. Incoming chairs almost never launch aggressive tightening into economic weakness during their opening months. The political fallout would be massive. They inherit a troubled institution. They build alliances with fellow governors. They fine-tune public messaging under intense global scrutiny. History shows a clear pattern: new leaders preserve stability at their debut meeting. Warsh is highly likely to hold rates steady initially, thereby stretching the current freeze even longer. Each extended week reinforces the gold tailwind, following the precise dynamic Miller illustrated in 1979. Longer paralysis equals larger price adjustment. Beyond the simple hold, the transition itself unleashes a more powerful force: maximum uncertainty around policy direction. No one yet knows Warsh's communication approach. No one knows his precise response to fresh data. No one knows whether his hawkish label translates into action or whether 1.4% growth forces moderation right from his first public remarks. Uncertainty of this magnitude strips advantages from nearly every traditional asset. Modeling a new chair proves impossible, yet you can hold an asset indifferent to whether any chair acts correctly. Gold has consistently outperformed during past Fed handovers exactly because it profits from ambiguity itself. Here then is your practical 3-month roadmap. 3 key economic prints between now and the May FOMC will dictate not whether gold rises but how quickly. First, watch the February Producer Price Index. If producer inflation surprises to the upside, it signals building cost pressures upstream. Sustained hot PPI locks the Fed in place longer, since easing amid rising input costs would erode remaining credibility. Gold benefits from the prolonged stall. Second, monitor the March Consumer Price Index. Should headline or core CPI re-accelerate, especially in housing and fuel categories, the transitory excuse from 2021 could resurface in updated form. Elevated CPI delays anticipated cuts. Real yields decline against hotter expectations, and gold follows its classic path. Third, track the April employment report. If joblessness edges above 4.3% or non-farm payrolls disappoint, stagflation fears intensify rapidly. Softer labor numbers revive cut expectations swiftly, and gold gains through forward-looking pricing. Now picture the combination that should both alarm and thrill you in equal parts. What if inflation data heats up while employment cools simultaneously? Idlisconsity and memorization. Hot producer prices, hot consumer prices, and deteriorating jobs all landing within the same window. That recipe defines classic stagflation. That mirrors 1973. That echoes 1979. That represents the precise environment where gold has delivered its most explosive, rapid, and powerful rallies historically. Current Lewis Fed indicators already point toward this zone. JP Morgan's global research team targets $5,550 per ounce for gold by the fourth quarter of 2026, with a trajectory aiming toward $5,400 by the end of 2027. This forecast comes not from some obscure newsletter but from one of the world's leading banks. Almost every plausible macroeconomic development over the next 90 days tilts gold upward. Velocity alone remains the open question. Let me weave these threads together because once the connections become clear, the overall picture turns impossible to ignore. The Fed sits frozen in place. This is not opinion. The dot plot reflects it, the unanimous decision confirms it, and Powell's latest remarks underscore it. All align with the stagflation signals already flashing from official data. History supplies three clear precedents for identical paralysis. Each delivered gold advances that shattered prevailing expectations. 73% when the stall proved brief under Burns, 325% when it lingered painfully under Miller, 12% even against the harshest tightening in 40 years under Powell. 2026 introduces an ingredient missing from every prior instance. Roughly 190 tons of quarterly sovereign accumulation, establishing a demand floor that retail-driven markets could never provide. Goldman anticipates easing by September. Futures markets point to December. Both schedules drive gold higher, albeit via slightly different real yield dynamics. The sole declining scenario, active rate hikes, carries zero market-implied odds globally. The Warsh handover, which might have seemed disruptive, instead prolongs the freeze, consistent with every historical new chair pattern of initial continuity. Each element bolsters the others. Historical precedent: the institutional bid floor, diverging rate forecasts, and extended leadership uncertainty. These are not isolated points. They form a single cohesive case examined from multiple perspectives, all converging in the same bullish direction. Recall how this discussion began. The decision ranked among the most telegraphed in years. 98.9% odds of no change, zero shock value, zero theatrics. Utterly predictable. Predictability, however, creates only the illusion of safety. The Fed foresaw holding, Goldman foresaw September, futures foresaw December. Three extraordinarily capable forecasting systems converged on one reality: continued paralysis. When every major institution anticipates the same standstill, the asset that actually moves is rarely the policy itself. It is everything valued relative to that policy. 90 days from today, your future self will reflect on this juncture with either sharp insight or quiet regret. All necessary information sits in plain view. Decades of historical patterns are well documented. Sovereign demand flows carry official verification from the World Gold Council. Rate path disagreements appear on every professional trading screen worldwide. The final question, therefore, is not what gold will do next. It is what action you take before the upcoming data wave arrives. Whether gold, silver, the upcoming Warsh transition, stagflation dynamics, or the central bank bid floor. Which topic should I unpack next? Let me know in the comments, because this space exists to transform intricate macroeconomic signals into practical choices you can execute.